I am not exaggerating you when I tell you that I get hundreds of emails a day from Forex traders asking me, why didn't this trade work out? Why didn't that trade work out? And it is constantly the same mistakes over and over again, which is why I decided that I needed to make this video to address all of the most common mistakes that Forex traders need to know. This video covers the top 10 mistakes that I see happen every single day. And, traders are making them. So I want you to be able to avoid them. And in fact, I think you need to watch this video 50 times so that you understand every single mistake in detail and not become the 90% of traders who fail. Yes, that's right. 90% of traders lose money, especially when they're just starting out. And a large part of it is because they're making these mistakes. So if you understand how to avoid these common mistakes, you'll already be ahead of the game. Hello everyone, I'm Lien with BK Traders, and my goal is simple: to share tips from my own trading experience and career to help shortcut your path to success. I want to help you become a confident, well-informed, and consistently profitable trader. If you're serious about improving your trading and you want more tips to level up your skills, make sure to subscribe and hit the notification bell so you never miss a new video. Whether you're new to trading or a seasoned professional, avoiding these common pitfalls is really the key to protecting your capital and improving your trading performance. So let's get into it. Number 1, not being aware that different currency pairs have different point values. This first and probably one of the most common mistakes that many Forex traders make is simply not knowing that different currency pairs have different pip, which is also known as point values. For example, when you're trading euro-dollar, a 1 pip move on a standard lot, which is 100,000 units, is worth $10, and it's always worth $10. However, if you're trading a pair like euro-pound, that same 1 pip move is worth around $13, 30% more. And for a pair like euro-yen, a 1 pip move may be worth less than $6. These differences may seem small, but they can significantly affect your profit or loss, especially if you're trading large positions or frequently. It can also affect your risk management and potential returns. It is important to know, for example, that a $200 stop in euro-pound will be fewer pips away from your entry than euro-dollar. So always check the pip value of the currency pair that you're trading, as it can influence your risk management and potential returns. And I dropped in a pip calculator in the description of this video. Number 2, ignoring the volatility differences between one currency pair and another is also a common mistake that many traders make. For example, pairs like pound yen and euro Aussie tend to be highly volatile, while others like euro dollar are more stable. This volatility, which can be measured by the average true range, also known as the ATR, can vary dramatically between pairs. And this should affect how much you let a trade run, and when it's in profit, or where you decide to put your stop. If you trade a volatile pair without adjusting your position size or stop loss levels, you might face larger than expected swings in your account balance. On the other hand, if you trade a low volatility pair without adjusting, you might not reach your profit target as quickly as you would expect. So make sure your strategy matches the volatility pair that you're trading to avoid surprises. Personally, I don't trade certain pairs like pound yen and pound Aussie because they are just too volatile for the stop that I'm comfortable using for our members, where we like to have a fixed 40 pip stop, for example, and that's too small for a pound cross. Number 3, not considering the time of day when you're trading. We all know the Forex market trades 24 hours a day, but not every part of the day is equally profitable to trade. Currency pairs move differently during different times of the day. For example, there tends to be very little movement between 4 p.m. and 7 p.m. New York time because the US markets are closed and the Asian markets haven't quite opened yet. During these hours, trading activity is limited and price ranges tend to be narrow, leading to fewer opportunities. On the other hand, the most active market hours are typically when we have the London session and the US session overlap, when most of the world's trading volume occurs. Being mindful and aware of the time of day and market session is essential to avoid entering trades during low volatility periods where price action can be flat or unpredictable. Number 4, misunderstanding currency correlations. Misunderstanding currency correlations and how they relate to each other is another big mistake that traders make. Some pairs like euro dollar and pound dollar tend to move together because of their relationship to the US dollar, while others like dollar yen and Aussie dollar may move in opposite directions. Ignoring these correlations can lead to unintended exposure in your portfolio. For example, if you're long euro dollar and you're long pound dollar at the same time, you're basically doubling your risk instead of diversifying. Conversely, being long euro dollar and short euro dollar Swiss may seem like they're two separate trades, but because these pairs often have inverse, which means opposite correlations, you're essentially doubling down on the directional bet. Understanding these correlations help you balance your trades and manage your risk more effectively. And basically, you won't be surprised why your losses are compounded when you're long euro and long pound dollar at the same time. Number 5, not adjusting for different spreads that each currency pair may have. Because each currency pair, the spreads vary, and this can have a direct impact on where you place your stop loss and your stop loss strategy in general. For example, a tight stop loss that works for euro dollar, which typically has a low spread, may not be as suitable for a pair like pound kiwi, which has a much wider spread, and it's part of the reason why I don't trade pound crosses. If you apply the same stop loss distance to different pairs without considering the spread, you risk being stopped out of trades prematurely, even if the market hasn't truly moved against you or the trend hasn't truly changed. Before entering a trade, check the spread of the pair you're trading and adjust your stop loss accordingly to give the trade the breathing room it needs. Number 6, overlooking overnight financing costs. Many new Forex traders don't know that if you hold positions overnight, you're likely incurring financing costs or swap rates, which is also known as rollover. These costs arise from the interest rate differential between the two currency pairs. Depending upon whether you're long or short, you might have the opportunity to earn or you might be required to pay interest for holding the position overnight. For example, if you're long a high-yielding currency pair like the Australian dollar against a low-yielding currency pair like the Japanese yen, you might earn interest. But if you actually are short Aussie yen, the reverse would be true, which means you are short a high-yielding currency and long a lower-yielding one, which would obligate you to pay interest. And that can add up over time and eat into your profits. It's important to factor this into your costs, especially if you're holding positions for multiple days. Number 7, forgetting about spread widening during rollover times. This is a huge mistake. Along these lines, a lot of new traders overlook is that spreads will widen in the rollover time. The Forex market's daily rollover time happens around 5 p.m. New York time, when liquidity is low and brokers adjust for the next trading day. During this period, spreads can widen significantly, 20, 30 pips, for no reason at all except for a rollover. If your stop is too tight, you could end up getting stopped out, even though the market hasn't really moved against your position in any meaningful way. To avoid this, either loosen your stop loss levels during rollover time, close your positions before and open it after, or avoid trading during this period altogether. Number 8, trading without considering economic data that's coming up. Forex markets are highly sensitive to economic data releases, and ignoring these can lead to large losses. Major events like U.S. non-farm payrolls, central bank rate decisions, inflation reports can cause massive volatility and price spikes. For instance, if you're trying to range trade right before a major data release like the U.S. jobs report, that could be disastrous if the market suddenly breaks out of its range due to new information, and it oftentimes will. So you always need to check the economic calendar before entering a trade and adjust your strategy or sit out when there's a major event on the horizon and only trade after the release. Number 9, holding on to trades based on a currency bias. This is another major mistake that traders make, which I can admit that I am sometimes guilty of, which is holding onto a trade because of personal bias towards a currency pair. For example, you might believe that the US dollar will appreciate long term, that it's oversold, so you hold on to a losing dollar position hoping for a reversal. This type of bias can cloud your judgment and often lead to larger than necessary losses and make you even ignore the good trades that are coming out. As traders, it's crucial to remain flexible and objective, basing decisions on the price action and market conditions rather than personal beliefs where a currency pair should go. Last but not least, number 10, focusing only on the major currencies. Many traders focus exclusively on the major currency pairs like euro dollar, pound dollar, dollar yen, and ignoring the potential opportunities in cross-currency pairs, which do not include the US dollar. While the majors are the most liquid and have the tightest spreads, cross-currency pairs like Euro CAD, Aussie Swiss are often present very lucrative opportunities, especially during specific market conditions. I could probably do a whole video on this because some of my most profitable trades are actually in the currency crosses, and I probably will. So if you don't want to miss this, once again, make sure you subscribe to the channel. With that said, the point is don't neglect currency crosses because sometimes they provide the clearest trading opportunities because the majors are often diluted by the market's appetite for US dollars. So that wraps up the top 10 Forex trading mistakes that you need to avoid. By staying aware of these pitfalls and adjusting your strategy accordingly, you'll be in a much stronger position to succeed in the Forex market. Let me know in the comments below which tip you like the most. If you feel ready to trade, check out some of our preferred broker and prop firm partners. In the description, there's some great discounts. And if you don't feel ready to trade, there's also some information on the trading courses. And also, I have the PIP calculator link in the description as well. I'll see you all next time.